President Trump is issuing an ominous warning. It would be impossible to ever recover or pay back those massive sums of money and honor. It would be 1929 all over again, a Great Depression.
The Great Depression was caused by a collapse in credit-based demand at a time of very low inflation. And now it's all happening all over again.
96 years ago today, billions of dollars were wiped out as the Dow plunged.
October 24th, 1929, Black Thursday.
Some called it the darkest day in American history.
The ratio of private debt to GDP in America peaked in 1932 at 132%. So why did we repeat the mistakes of the 1920s and the 1930s when we knew what to do to avoid them? What caused the Great Depression? A YouTube viewer asked me to explain the greatest downturn in the history of capitalism, and as it happens, that's easy. The Great Depression was caused by a collapse in credit-based demand at a time of very low inflation. As you can see from this figure here, credit fell from roughly 8% of GDP per year in the 1920s to, on the US Census figures, which are the only ones available for this period of time, minus 30% of GDP in the early 1930s. Inflation, which had averaged 0 for the 1920s, fell to minus 10% per annum in the early 1930s. And the key causal factor behind this disaster was the level of private debt. The ratio of private debt to GDP in America peaked in 1932 at 132%, which at the time was the highest level that had ever been recorded. This cause was identified way back in 1933 by the famous economist Irving Fisher, having disgraced himself with his claim just weeks before the stock market crash of October 1929 that stock prices have reached what looks like a permanently high plateau. He spent the next few years trying to work out why he had been so wrong. Now, he realized his mistake was to think about the economy as if it were in equilibrium. Even if economic variables did tend towards equilibrium, he reasoned, the exact equilibrium thus sought is seldom reached and never long maintained. New disturbances are, humanly speaking, sure to occur, so that in actual fact any variable is almost always above or below the ideal equilibrium. Economists, therefore, according to Fisher, had to think in disequilibrium terms, because, to quote him again, at most times there must be under or over production, over or under consumption, over or under spending, over or under saving, over or under investment, and over or under everything else. It is as absurd to assume that for any long period of time the variables in the economic organization or any part of it will stay put in perfect equilibrium as it is to assume that the Atlantic Ocean can ever be without a wave. And he concluded that the two dominant factors that caused the Great Depression were over-indebtedness to start with and deflation following soon after. And by the way, if you want to use my proprietary software Ravel for economic analysis too, you get it as a free bonus inside my 7-week Rebel Economist Challenge, like over 600 people have already done. To learn more, apply at stevekeen.com. He acknowledged that there were many other factors, but he insisted that these two economic maladies, the debt disease and the price level disease, or the dollar disease as he called it, in the great booms and depressions, more important causes than all the others put together. Now, these two factors dominate all others because of a phenomenon that I named after Fisher, Fisher's paradox. Starting from a high level of private debt and with already low inflation, retailers and wholesalers dropped their prices in an attempt to get customers to shop with them rather than with their rivals. But since everyone is cutting their prices, the price level drops even further, and that increases the burden of debt. In Fisher's words, this is what happens. The very effort of individuals to lessen their burdens of debts increases it because of the mass effect to stampede, to liquidate, in swelling each dollar owed. There we have the great paradox, which I submit is the chief secret of most, if not all, Great Depressions. The more debtors pay, the more they owe. Now, Fisher provided some statistics to support his analysis, but 1933, he noted, liquidation had reduced the debts about 20%, but it increased the value of the dollar by 75%, so that the real debt burden was increased by about 40%. US Census data, which wasn't available to Fisher when he wrote, confirms his analysis. Private debt peaked in 1929, but the ratio of private debt to GDP continued to rise until 1932, because GDP fell faster than private debt fell. So the data strongly supports the roles that Fisher attributed to credit and low inflation in causing not just the bust of the 1930s, but also the boom of the 1920s. Unemployment was low in the 1920s because credit was high. Credit was close to 10% of GDP between 1923 and 1929. Then unemployment exploded in the 1930s because credit turned sharply negative. On census figures, credit was as low as minus 30% of GDP in 1932, which was the worst year of the Great Depression. And similarly, Similarly, inflation was very low in the 1920s, while prices fell by up to 10% per year in the early 1930s. Much of this was credit-driven as well, with a positive correlation between credit and inflation being almost equal in magnitude to the negative correlation between credit and unemployment. Now, this led to some very simple advice about how to avoid another Great Depression. Don't let private debt get too big. Don't let people speculate using borrowed money. And if you do fall into a debt deflation, then use government spending to stop the rot. He was adamant that the downward spiral that commenced with the Great Crash in 1929 was only stopped by the reflation caused by the New Deal, and he had harsh words for its critics. As he put it, those who imagine that Roosevelt's avowed reflation is not the cause of our recovery are very much mistaken. Had no artificial respiration been applied, we would soon have seen general bankruptcies of the mortgage guarantee companies, savings companies, banks and life insurance companies, railways, municipalities, and the states. So that's what caused the Great Depression. Too high a level of private debt, too low a level of inflation, and credit turning from positive to negative, and in the early years, government spending being too low to counteract the effect of the downturn. So then, why did we let exactly the same set of circumstances develop over the next 50 years? Private debt more than trebled relative to GDP between the end of World War II and the Great Recession. Credit-based demand collapsed from being equivalent to plus 15% of GDP in 2006 to minus 5% in 2009. Inflation was relatively low in the early 2000s too. So why did we repeat the mistakes of the 1920s and the 1930s when we knew what to do to avoid them? The blame lies with neoclassical economists. They ignored Fisher because to take Fisher's advice seriously, they would have had to abandon the equilibrium reasoning that they prefer, and they would have had to include banks and private debt and money in their macroeconomic models, which they omit. The analysis and the advice that Fisher gave contradicted the core principles of the neoclassical paradigm, which include reasoning in equilibrium terms rather than disequilibrium, and assuming that banks are intermediaries rather than originators of both debt and money. So rather than learning from Fisher, they ignored him. And the standout here is Ben Bernanke. He got the job as Federal Reserve Chairman because he sold himself as the expert on the Great Depression, but he wasn't. He dismissed any explanation of the Great Depression that was inconsistent with neoclassical economic theory, and that included Fisher. Well, Bernanke acknowledged Fisher's argument that the Great Depression was caused by the bursting of a private debt bubble, but he then rejected Fisher's analysis, and this is in Bernanke's words, because of the counter-argument that debt deflation represented no more than a redistribution from one group, debtors, to another group, creditors, absent implausibly large differences in marginal propensities to consume. Isn't he an exciting writer? It was suggested pure redistributions should have no significant macroeconomic effects. Now, Fisher himself knew this argument was spurious, and he said so in 1932. The neoclassical model of banking treats banks as intermediaries who enable savers to lend to borrowers, but who don't actually do any lending themselves. Now, this is peer-to-peer lending, and Fisher knew this couldn't cause economic crises. He wrote in his book, Booms and Depressions, published in 1932, that, and I quote, "A man-to-man debt may be paid without affecting the volume of outstanding currency. For whatever currency is paid by one is received by the other and is still outstanding. But when a debt to a commercial bank is paid by check out of a deposit balance, that amount of deposit currency simply disappears. When, by reason of a general state of over-indebtedness, there is a stampede of liquidation, there must follow a net shrinkage of deposits or credit currency. And that's why bank lending is totally different to peer-to-peer lending. Now, I can easily demonstrate what Fisher is talking about here with a simple model in Ravel. This model shows the loanable funds model that economists cling to, despite the evidence against it, in which banks are just intermediaries who enable creditors to lend to debtors. Now, huge variations in credit and private debt levels have no effect on GDP in this model. So, as Bernanke claims, and as Fisher knew, man-to-man debts have no significant macroeconomic effects. But bank debt is different, as Fisher asserted. This is the model of banking that neoclassical economists prefer, put into my Ravel software rather than shown in the typical supply and demand diagrams that economists use for virtually everything. And what the model argues is that banks don't actually lend money. Banks instead are supposed to be intermediaries that enable one group of non-banks, creditors, to lend to another group of non-banks, debtors. And then, according to this model, a change in the level of lending has no real impact upon the macroeconomy. So let's see how the model works out. So what the model first of all has is creditors lending to debtors. So there's a flow of credit dollars per year from creditors to debtors, and that can be positive or negative. If it's positive, new debt's being taken out. If it's negative, debtors are repaying their debt. Debtors then have to pay interest to the creditors, and the bank then charges a fee. And for simplicity in this model, I'm having the bank spending all the income they earn, so I can just focus upon the amount of money in the accounts of creditors and debtors. So interest is paid on the level of outstanding debt. The banks then charge a fee, and they then spend that fee. And then total economic activity is the turnover of money, which is the sum of what's in creditors and debtors' accounts. And so that's what's give you GDP, and then a certain fraction of GDP is lent out every year, and I can vary that when I run the simulation. So let's run the model first of all, and this is what conventional economists think is the behaviour of the banking sector, which is why they leave the banking sector out of their models, and they don't look at the banking sector to try to explain what happened with the Great Depression. So we have no lending at the moment, so nothing is changing. If we have credit being, say, 1% of GDP or 2% or 3%, then the distribution of money in the economy changes radically, but nothing happens to GDP. And if I now have debtors repaying their debt, then the distribution of money shifts dramatically again, but again, nothing happens to GDP. So in this model, you're quite valid to ignore the banking sector when you look at the economy, and credit has no significant macroeconomic effects. But of course, this model's a farce. It's a fallacy. It's not what actually happens. It's not the creditors that are doing the lending, it's the banks. So I can delete showing debt as an asset of the creditors here and say, in fact, it's an asset of the banks. That's one change. Then the intermediation fee. Yes, banks make money out of charging fees, but that's not the main game for them. It's interest income that they make their money out of. So I'm going to delete the intermediation fee from the model. And then what I've now got is the interest payments are currently being shown as going to the creditors. That's not true, so I can get rid of that, and the creditors aren't doing the lending either. Instead, the interest income goes to the banks, and just to reflect this, I now flip this switch so banks spend their interest income rather than the fee, which was the previous model. So now I've gone from the false model that neoclassical economists prefer at the banking sector to the real world, and this is the model that Fisher said is why the debt deflation caused the Great Depression, because people repaying their debts caused the money supply to contract, and that caused the downturn of the Great Depression. Let's go. Same thing. If there's no lending, then nothing changes. But if you have credit, then credit causes GDP to rise and the money supply to rise. And keep it increasing, you get a larger level of economic activity. What happens if debtors start to repay the debt? Then when credit turns negative, GDP declines as well. You must have the banking system in your model of the macroeconomy, and it's a plunge. The Great Depression was caused by debtors liquidating, therefore reducing the money supply and causing the economy to collapse. This is the real world. This is what we should be modeling. Neoclassical economists with their fantasy model are why we haven't learned from the Great Depression, and why we reproduced the same problems for the Great Depression in the global financial crisis. So Fisher was right and Bernanke was wrong. And having dismissed Fisher's analysis on spurious grounds, Bernanke went on to ignore anyone who had actually taken Fisher seriously. For that reason, he completely ignored Hyman Minsky, who gave us the financial instability hypothesis, which was inspired by Fisher's debt deflation theory. This is all that Bernanke had to say about Minsky's work in his book Essays on the Great Depression. Hyman Minsky and Charles Kindleberger have in several places argued for the inherent instability of the financial system, but in order to do so, if it had to depart from the assumption of rational economic behaviour. He adds a footnote, and the footnote says, "I do not deny the possible importance of irrationality in economic life. However, it seems that the best research strategy is to push the rationality postulate as far as it will go." That's the end of his discussion of Minsky's financial instability hypothesis. So having misinterpreted Fisher and ignored Minsky, the only explanation that Bernanke had left for the Great Depression was the Fed did it. And that's exactly what he concluded. This is again a quote from his Essays on the Great Depression. The monetary data underscore the stinging critique of the Fed's policy choices by Friedman and Schwartz. Continued contraction in the ratio of base to reserves reinforced rather than offset declines in the money multiplier. This tightening seems clearly inconsistent with the gold standard's rules of the game and locates much of the blame for the early pre-1931 slowdown in world monetary aggregates with the Federal Reserve. Now he and all mainstream economists ignored the increase in private debt that Fisher had warned about. And this is why the hagiography that Bernanke gets really annoys the hell out of me. He's given credit for rescuing the global economy from the global financial crisis. But he and his neoclassical colleagues ignored the factors that actually led to the crisis in the first place. He's like the arsonist who gets an award for putting out a fire, but actually one step less than the arsonist, because at least the arsonist actually knows who started the fire. The global financial crisis was no black swan. It was an obvious consequence of letting private debt get too high, which Fisher had warned against during the Great Depression. It gave the economy an artificial sugar hit in the 1990s and 2000s while credit remained positive and boosted aggregate demand, and in fact it did that right from 1945 until 2007. Credit was positive for that entire duration. Then it turned negative, as it did during the Great Depression. So we walked straight into a crisis that a realistic approach to economics would have avoided by following Fisher's advice and limiting rather than encouraging financial speculation. The only way in which future generations benefited from the horror of the Great Depression and World War II was by the huge increase in government spending that came at that time. Before World War I, government spending, believe it or not, was often no more than 2% of GDP. After World War II, it rose by a factor of 10. Now, mainstream economists are critics of big government, and they're forever trying to reduce the scale of government spending. But in the real world, that large increase in government spending meant that when the downturn occurred in the Great Recession, the level of government spending was far larger in response than it was to the start of the Great Depression, because tax revenues fell and welfare payments increased. This increase in spending countered the fall caused by credit turning negative in the first place, and the government deficit during the global financial crisis reached 10% of GDP, and that's twice the level that it was at the peak of the New Deal. Having failed to learn from the Great Depression, neoclassical economists are now busy learning how to fail to learn from the global financial crisis. The immediate error they made was not only to ignore the level of private debt, but even to think they should encourage the private sector to get into even more debt at the peak of the crisis. Part of the justification for quantitative easing was that it would encourage more bank lending, as Bernanke explained in 2009. The idea behind quantitative easing is to provide banks with substantial excess liquidity in the hope that they will choose to use part of that liquidity to make loans or buy other assets. Yes, they can buy other assets with the reserves created by quantitative easing, but it's impossible for them to lend reserves. Now, this is one of the main reasons that private debt is still too high, almost 20 years after the GFC. As horrible as the Great Depression and World War II were, the silver lining from those dark clouds was a huge plunge in the level of private debt. By 1947, 15 years after the peak level of debt in 1932, the private debt ratio had fallen by 65%. And this is one reason that those early post-war years were the golden age of capitalism. However, 15 years after the GFC, the private debt level has only fallen 15% from its peak. And this is a major reason why the economy has been so stagnant since the GFC. With private debt as high as it is, banks are reluctant to lend and firms and households are reluctant to borrow. Credit-based demand is therefore anemic, and the economy stumbles on, kept positive mainly by large government deficits that neoclassical economists are still trying to eliminate. Today, Gauti Egerton is the leading neoclassical interpreter of the Great Recession, and just like Bernanke before him, he uses the false loanable funds model of banking, so he can't see an explicit role for bank credit in causing booms and busts. Now, these were the two mistakes that Fisher said we had to stop making way back on the Great Depression. This is why he didn't see the crisis coming, to his own great personal cost. He tried to warn us, but his warnings were drowned out by neoclassical economists who wanted to hang on to their models of banking, and they wanted to continue reasoning about the economy in equilibrium terms. That mattered more to them than explaining why the Great Depression occurred. And now it's all happening all over again. So listening to a neoclassical economics on any topic is bad for your economic health. But certainly listening to them about government debt and private debt is an extremely silly thing to do. It's time we broke away from the stupidity of neoclassical economists, because they'll never try to get to grips with the actual behaviour of a capitalist economy that is so different to their model of a perfectly equilibrating, balancing system.
Like many other truth seekers, I want to learn 50 years of real economics from me in only 7 weeks. You'll love my new 7-week Rebel Economist Challenge as well. To apply, go to stevekeen.com. If you qualify, you can attend my lectures, ask me questions personally every week, and make friends with a great group of like-minded people. So again, like many others, go to stevekeen.com to apply as well for the 7-week Rebel Economist Challenge. Good luck.